Most businesses waste thousands of dollars and months of time building the wrong software. Over years of building custom software for businesses, here's what I've learned. The businesses that succeed don't start with the biggest problem, they start with the most expensive problem. And that expensive problem is a workflow that's quietly costing you 5 to 10 hours per week, every single week. It's not dramatic, but it's draining your resources constantly. Now, I've actually built an AI tool to help quickly figure out what's worth building for your business. You just need to give it some information about your processes and your time sinks, and it will generate your current inefficiency costs, along with a potential scope breakdown for a custom build and the potential return on investment of that build. There'll be a link to it in the description. I wanted to quickly show you that before I mention anything about frameworks and calculations. Ugh. Most business owners actually have no idea which workflows are their most expensive ones. They're guessing based on how annoying something feels, not what it's actually costing the business. And in this video, I'm going to show you how to figure out which workflows in your business are actually worth building custom software for. By the end, you'll know exactly where to start, and more importantly, what to ignore. Now, before we dive in, let me show to you why what I'm about to explain can be the difference in thousands of dollars wasted or thousands well spent. So I recently dealt with a consulting firm who wanted a client portal built out, and their vision was everything you can imagine. So they wanted proposals, contracts, payments, project tracking, team communications. I haven't included everything here, but you can imagine they wanted basically every feature possible, which then was estimated for the full build to be around $80,000. However, this consulting firm was only doing about $800K in revenue a year. So this project in and of itself would have been about 10% of their revenue. And within this project, there were a few key features that were by far and wide the biggest time savers if they were to be built. So in this case, we had the proposals and the contracts. And if this problem was to be solved, then these by far out of all the features would have had the biggest time saving and thus the biggest cost saving to the business. Thus, what we ended up proposing was instead of building absolutely everything, we build just the key features. And that, in the end, only ended up costing around $30,000. And so for them, the blockers that were directly impacting revenue were now solved, and the payback on the custom-built software was much less as opposed to if we had built absolutely everything. And so how do you figure out what's worth building? Well, it's simple. 2 numbers. First, what's this costing you now? So take the time your team wastes on this per week and multiply it by what their time is worth. And the key point around what their time is worth is that you shouldn't just consider their salary, because there's also the opportunity cost potentially associated with it. For example, in the case of a salesperson, if they're doing 5 hours of manual data entry per week, then it's not just the 5 hours of their salary, it's also the 5 hours that they could be selling. That's the potential opportunity cost. So let's go with that example. Let's say your team is spending 5 hours a week on manual data entry, and let's say their time is worth $25 an hour. And when I say time, I mean just their salary costs, no opportunity costs. And if we look at that over the course of a year, then on an annual basis, that salesperson alone in their salary is wasting $6,500 a year. And if you were to factor in the opportunity cost in this scenario, then this final figure can obviously become exponential. When they're closing, that salesperson's time could be worth $50 an hour, it could be $100 an hour, maybe even more. So small things that seem inconspicuous can really rack up. And this only accounts directly for the person's time. It doesn't account for any of the software that they might be using and the costs that come with getting them seats and subscriptions in those software. And the second thing we need to consider in the calculation is the cost of the solution. So if we were to build a custom tool to solve our problem, how much would that build cost? So let's say in this scenario, it would cost $5,000 to build a custom solution to fix our problem. Now with this cost of $5,000, if we compare this against how much our problem is costing us a year, so the $6,500, then it would be give or take roughly 9 months before the tool had paid for itself. And remember, this $6,500 a year in this example was just the time cost. It didn't consider any of the potential opportunity cost or subscription costs. So if it's a high value member of your team who is wasting their time on whatever bad software you have, then this figure could ultimately be much higher. And so you want to compare the cost of the solution versus however much it's costing you a year to figure out the payback. If the payback is 1 to 2 years or less, then it's probably worth building, and anything beyond that, it's circumstantial, but it's usually not worth building. However, with these calculations, there's 3 big nuances the numbers don't tell you. Let me show you what I mean. So nuance 1. Now the calculator tells you the payback period, but what it doesn't tell you is the risk involved. And one of the key determiners of this risk is whether or not this new product will be client-facing or internal-facing. Client-facing could be things such as sales, onboarding, customer service, things that directly impact your revenue. Ultimately, if you get these things wrong, then you lose deals, you lose customers. However, if you get them right, then the upside is huge. And internal-facing tools usually mean things like task tracking or reporting. Things that your team will complain about, but they won't directly impact revenue. There's lower risk, but there's also lower upside. So in this example of a custom client portal versus a custom metrics dashboard for internal team members, the payback may seem the same on paper, but the risk profiles would differ massively. So when you calculate payback, ask yourself, is this directly impacting revenue? If yes, you can be more aggressive. If no, be more conservative. Now, Nuance 2. So the calculator shows you what you should build, but what it doesn't show you is how you should build. Now, when it comes to figuring out how you should build, usually there's two core options. The first option is to build it all at once, and the other is to build it in pieces. And most of the time, the recommendation would be to build in pieces, but it's very circumstantial. So as an example, let's say you had a real estate company who wanted to replace their CRM. And let's say for the example, when the real estate company did these calculations, they realized the payback of this software was going to be 3 years. Now, a payback period of 3 years is usually pretty hard to justify. And so instead, in an example like this, it'd be much better suited to try and figure out the biggest lever in terms of the workflow that's costing the most amount of time and thus potential revenue. And so let's say for them that the biggest potential lever they could pull would be material order tracking. Something could be built to fix this one massive issue, and it would probably cost a fraction of what it would be to replace the entire CRM. Then once there is something built to fix that one biggest problem, you can see based on the impact that it's had, whether or not it makes sense to invest more resources and scale it out. However, this is the ideal. Sometimes circumstantially, it just doesn't make sense to build one thing like this that fixes a single problem, because that one thing you build might have many dependencies then on the other tool that the business would have to continue to use. However, in the case of the real estate company, if when we dived into it, we were to realize that this CRM that they're using currently links off to Airtable or links off to Google Sheets or links off to some other industry specific software, and this new material order tracking tool would then have to have a data sync with all these other tools in the ecosystem, then sometimes, to be honest, it just makes more sense to build the entire thing up front, because if you were to build it in pieces in an example like this, then at a later stage, you have to figure out how to migrate all the data, and that ultimately just means more costs involved in the long run. So in summary for this second nuance, if what you're building can work alongside your existing tools, then build it in pieces. However, if there'll be many dependencies, then it's worth considering that modular might actually cost you more in the long run, and thus it might be worthwhile just building the whole thing up front. Now, the third and final nuance that calculation doesn't cover is the revenue percentage. So let's say you had a 50K project with a 12-month payback period. It sounds great, but if that business is doing 250K in revenue a year, then this 50K project is costing them 20% of their total revenue. So even though the ROI here is great, the risk is pretty large. If the build is more than 20% of your annual revenue, then be very careful. Either start smaller or just wait until you're bigger. So how do you now apply this to your business? First, list 5 to 10 workflows that cause the largest amount of pain in your business. Then for each of those workflows, calculate the annual cost. So this is your time wasted, multiplied by what your time is worth, and then times 52, the number of weeks in a year. And then also in this annual cost, don't forget to include any potential opportunity costs that you might know about, and then also any subscription fees that you might have for the software that you use. Then secondly, for each, calculate the build cost. Now for this, you'll probably need to get in touch with a few potential builders for estimates of how much this would take to build. As I mentioned at the start of the video, I've built an AI tool to help with this estimation. There'll be a link to that tool in the description. And in that tool, you can just give it an overview of your business and your current setup, and it will give you a complete breakdown of the potential costs. And then finally, once you have the annual cost and the build cost, you can calculate the payback. So how long will it take, given how much this software could save me, to see a return on my investment? Then once you've done these calculations, there's a few things to consider. And the first thing to consider is whether or not what you want to build is client-facing or internal. If it's client-facing, then it usually means it's going to directly impact revenue, and thus it's quite easy to justify the new tool being built. However, if it's only internal, then it's usually a lot harder to justify it just because the return on investment isn't as easily tracked. But it obviously doesn't mean that you shouldn't build something if it's only internal facing. It just depends how much time your internal team members are currently wasting with your current software setup. The second thing to consider is whether or not this new build can be done in pieces or whether or not it needs to all be done in one build. It's idealistic to build it in pieces. There's usually lots of dependencies. If you can build it in pieces because there is no dependencies, then by all means you should build in pieces. However, if this new tool will have a lot of dependencies on some of your existing software, like having to manage data syncs, then it's worth having a long think about whether it's realistic that this new tool could end up replacing all of your other tools at some point in the future. Because when that time comes, you'll ultimately have to migrate all of the data from your current tools into this new custom tool. And that's much easier to do at the very start as opposed to a later date. So in the case of dependencies, it's better to build all in one. And the last consideration, will this build be under 20% of your revenue? Pretty self-explanatory in terms of risk, and in truth, 20% is still a pretty high figure. Ultimately, it should be less than 10%, but I have seen a couple of cases where, given the business profile, it was under 20%, but more than 10%, and it made sense for the business. So an absolute maximum figure, I would say, make sure it's less than 20% of your annual revenue. And so when you do ultimately perform these calculations, then you'll likely uncover a handful of workflows that are taking up the most amount of time for your business. And then based on the payback and the other considerations, you can decide if custom software makes sense. Now, to be able to properly use these calculations I've just shown you, you need to first know exactly what's taking up the most amount of time in your team's processes. And I just so happen to have created a video on how to map these processes to figure out what's eating up their time and ultimately your business's money.